You might think interest rates are just a finance department thing, some mysterious number set by people in suits you'll never meet. But here's the truth. If you're building models, any models, you already work for the interest rate. You just don't know it yet. Because whether you're valuing a company, forecasting demand, modeling growth, or calculating risk, interest rates are the silent puppeteer pulling the strings behind the scenes. And if you're not paying attention, they'll quietly wreck your model before your first formula finishes calculating. So today we're pulling back the curtain. I'll show you what interest rates really are, how they work, and why no model, no matter how brilliant, can afford to ignore them. What if I told you that a small tweak by the Federal Reserve could quietly wreck your model's assumptions and cut your forecasted value by 20% without changing a single line of your Excel file? That's the hidden power of interest rates. And if you're modeling anything, business valuations, consumer behavior, or loan risk, you need to understand how they work. Interest rates are the cost of borrowing money and the reward for saving it. When you hear someone talk about the rate, they're often referring to the federal funds rate, which is set by the central bank. In the US, that's the Federal Reserve. Think of it like the anchor point. That one rate influences everything from mortgage payments to credit card interest, auto loans, business financing, and even international investment. When the Fed raises rates, borrowing gets more expensive. People and businesses spend less. When they lower rates, borrowing becomes cheaper, which fuels growth. So how does this connect to modeling? Let's break it down. In valuation models like DCF, discounted cash flow, you need to bring future money back to today's value. The discount rate often includes an interest rate component. The higher the rate, the lower your valuation. Interest rates feed directly into a firm's weighted average cost of capital, WACC. When rates rise, WACC goes up, and that can flip an investment from go to no-go in your model. High rates mean consumers borrow less and save more. That affects demand modeling, especially for big-ticket items like homes, cars, or education. Companies will defer expansion or hiring if interest costs eat into returns. That shows up in modeling headcount, capital expenditures, or market growth scenarios. Let's make this real. Imagine you're modeling a company that generates $100,000 a year in free cash flow for the next 5 years, and you expect to sell it for $500,000 at the end. At a 7% discount rate, the company is worth about $766,000 today. But if the Fed hikes rates, and now you have to use a 10% discount rate, that same business is only worth $689,000. You just lost $77,000 in value, more than 10%, without changing a single assumption about performance. That's what interest rates do. They silently tilt the entire economic landscape under your model. As a modeler, you don't need to become an economist, but you do need to watch the macro landscape. Ask, what's the current rate environment? What are future expectations? Are we in a rising or falling rate cycle? And when modeling anything involving time, cash flow, debt, or investment, don't just plug in the discount rate, justify it. Understand where it came from and how it might change. Interest rates aren't just a finance thing, they're a modeling thing, and getting them wrong means you could miss the story your model's trying to tell. If you want to go deeper, grab the free download, The Modeler's Market Primer, a cheat sheet of core business and economic forces every analyst should know. Links in the description. And hit subscribe for more videos like this, where we connect real-world forces to smart grounded modeling.